Welcome to the podcast where we discuss all matters financial planning and investing. This content contains general information only and may not be relevant to everyone. Please contact our office to make sure and determine if this is relevant for you. Hi and welcome to the podcast. I'm David Lockton and I'm joined by my co-host Cole Eccles. How are you, Cole?
Doing yourself, Dave?
Very well. And today we're going to talk about probably a thing that's been in the news a little bit lately is the proposed extra tax on superannuation over $3 million was on the news. What have you heard about and what's your view on it?
I think the additional tax over balance over $3 million came in a couple of years ago maybe, but what got everyone talking now is that there's this like fine print or something that's come up where they're talking about taxing unrealised gains within super funds. So that's the big one. But the government's selling it as doesn't affect that many people. I think it's 0.5% or 80,000 superannuants, but they're saying it's not a big issue at the moment. But one of the things that you're going to raise later on is the indexation of that, or the lack thereof, which will catch people out down the track.
Yeah, it's one of those things. I think it's one of the confidence things we lose in governments different times. When they're trying, basically the premise comes down to they're trying to raise more tax.
Yeah.
They've come into this election and giving a lot of money away, which generally all governments do. And they're looking for ways to pay for it. And they've brought this up a couple of times that it's been knocked back on and they haven't had the support. And just for the viewers as well, it's not through Parliament yet, so it's not law.
Yeah.
So what we're talking about is a little bit of hearsay at the moment. But they do now have the support of the Greens, which is they have the power and also the numbers to really do what they want over the next period, which definitely can be alarming.
Yeah.
But what I think it's alarming with there's no opposition where, you know, they're basically what they're looking to do is tax superannuations over $3 million. Because right now, when you've got superannuation, you pay 15% tax on earnings and so forth. And growth's got a different formula that it works on. But anyone who has over 3 million in superannuation, they're looking to increase that 15% tax to 30% tax. And also the kicker, which hasn't been really talked about before, is taxing investments or shares or property or businesses in there at taxing capital gains. It hasn't been realised yet, which is
big one. Yeah.
It's the big one. It's you were mentioning before we came onto this that they've tried it somewhere else and what happened there.
I was reading an article that in Norway, they actually do it. And it's not their super system, but they tax individuals' unrealised gains. They call it, paper profits, I think it is, or the guy that wrote the article was talking about it. And I forget the exact numbers, but they've lost. So the reason why they brought it in was the same reason, was to raise tax revenue, to fund social security pretty much over there. What's happened is a lot of the really wealthy people have left Norway because it's the same as there, it's taxing business as well. So anyone with a business, and if you don't have the money to pay the tax, you've got to sell assets. So business can't basically grow. And so what they've done is a lot of their really wealthy people have fled Norway, and that's cost them tax revenue with those people leaving. And so in the end, forget the exact numbers, but the amount of the revenue they wanted to raise in tax, they have now lost, I think, more than double that with people leaving. And this article is about, be careful, like really Australian government should look at the Norway case before you go. Because at the moment, it's like it only affects 80,000 people, 0.5%. So people are like, oh yeah, they got money anyway. So people don't really think, the consequences.
It's once you open the door, right? This is what I find. Once you open the door and if it goes through unnoticed, and look, a lot of people are happy to tax the wealthy more. Let's be honest, in Australia, I have this argument with a few different people, but which I think it's unfair at times, but everyone else thinks maybe it's fair. But it's if you open the door on this untaxing realised gains, where do they stop with it? Yeah. And with the government, they've got to fund their spending and so forth, and then it can come into other things. But obviously, if it goes too far one way, it can be taken back, and there's problems that come with that. But right now, it's one of those things that $3 million seems a lot of money for a lot of people, and most people won't have that in superannuation in their lifetime. Right. Let's be honest. But if the number doesn't index over time, so there's no talk about that $3 million going up every year. $3 million now seems a lot. Yeah. But if you got kids that starting the workforce now and they're putting money into superannuation, by the time they get to 60 years old or to be able to access super, a lot of those people will be well over the $3 million mark. Yeah. That creates a different problem. And also everyone in between, in the middle, that may have been aggressively putting in money in the superannuation, they could be affected as well.
Yeah, I think I know AMP done some modelling around this, and I read an article, I forget the exact numbers, but their modelling shows, I think, if you take the average income in Australia today, if you take someone, I think it was like a 24-year-old earning the average income, getting the standard 12%, not making extra contributions, I think by the time they get to their mid-40s, they would have breached that $3 million cap, assuming bouncing. So they're saying it doesn't catch a lot of people now, but it's going down the track, you'll find that there'll be a lot of people caught up in it.
Yeah. Let's talk about a few of the problems. So if you actually did have over 3 million in superannuation now, look, if people have shares and so forth, or some investments that they can sell a portion of to pay the tax, it's going to be painful, but not such a big deal. Yeah. But if you have a business in there or you have property in there, where do you get the money?
But the Norway case is you've got to come up with it. You've got to sell other assets.
So, so that can be a major one. And if you've got to sell assets to pay a tax, what happens if the shares or the property go down the following year?
We're talking about if you have a good year this year and you're paying tax on it, the next year you have a loss on paper. You haven't realised it. And then what happens then? Do you get a credit? Do you get money? I don't know.
No.
And that's the thing.
There's no talk about actually getting the money back. For a lot of people, there's a lot of people that have put farms in there or businesses in there and different types of assets into their superannuation, which will have a hard time paying it. And even obviously, one of the things I find the government haven't explained well is all these little parts of it, or they're not forthfront in come and telling you how these things are possible and whatever, because they think it's just hitting the wealthy. So we just slide this one through with the Greens. So I think that has a problem. So what would be the alternatives for people?
Well, it's an interesting one. Obviously, super is still tax effective. And I think that's what the government's saying. It's still concessionally taxed. It's only 30% as opposed to 47 cents maximum, including Medicare. I think people started looking at investing in other areas. Now, there's other tax advantage investments that's not in super. That's taxed at 30%, where you don't have limitations of what you can get in and pull out, etc. So people may start to look to that. And that's the issue, I suppose, is super was brought in to help people fund their retirement. You mentioned before they need to raise tax, and you'll find every time there's changes to super, it's when tax needs to be raised. It's always the easy one to go at, and it creates this sort of uncertainty with super. So you may find people invest in other areas outside of super. And another article there, I think it was Australian Financial Review, and they said the people that will be most affected or most hurt with this is the ones that actually don't plan or get advice. And they talked about, you mentioned about business putting their property in SMSF, what that commercial property would be in a few years, and if you don't plan. So really, we'll wait to see if it comes in or not, and then plan around that.
It does. It's one of those things. At the end of the day, the government had a retirement problem, and so they pushed out when you could access your super, or when you get access to the age benefit, but also how much you're putting into super. It's a bit cheeky to come at the other end and start taxing it more as well, because there's so much in super. I think so. I think for most people, look, it's depending on if you're over 40 now. I think for most people, it's not really going to be a problem. It's not going to be a big problem for most people, but those people that are really in that bracket that are going to be potentially hitting the 3 million market, I think it comes down to just really understanding your contribution strategy. I think that's one thing to really have a look at, is how much am I putting in there, and can money go to spouses and so forth, and all those type of things. So depending on what yours is going to look like, and if it is going to get higher than that $3 million, you do have the opportunity when you switch to pension phase initially to reduce it down immediately. And that's where basically it comes into account. Depending on your scenario, you might be able to invest through companies and invest through trusts and all those sorts of things. And if you've got family, generally the tax rate that they're going to on tax on earnings is around 30%, and that's pretty much the company tax rate. But the thing they don't do in companies at the moment is they don't tax unrealized gains. So that is critical. And if they ever done that in the company scenario or the individual scenario, I think that would be World War III. It would be just an uproar, but it'd be World War III. But who knows in 20, 30, 40 years, depending on what they're trying to raise, how much revenue they're trying to raise, which way they go. So I think really planning for your contribution strategy would be number one, to see where you are. If you're going to hit over that, depending on what assets you have in there, it might be a problem, it might not be. And you may be able to pull some out. So it's working with someone who knows the area that you can pull some money out of super and invest through different vehicles under your personal name. When people get to retirement a lot of time and they're not working anymore, they can earn so much money before they pay any tax. So it might be in the individual name, it might be in companies' names, or held through trusts or whatever it may be, distribute to family wealth. There's a whole range of things, but I think it becomes another area that you just really need to seek some advice on at the time. Pre-planning, And as you're moving through, when you're earning that sort of money to hit 3 million, I think within the next 20 years, if anyone's looking to do that, getting some advice and how to minimize it, but also maximize your wealth potential. Because in Australia, that's what we're trying to do. We're like, superannuation taxed at 15% is a bit of a gold mine.
It is, yeah.
Do you know what I mean? It's like a sleeping giant. No one talks about too much and so forth. But now we're going to probably be talking about it if these things go through. So there's no guarantee it will go through. Look, they're going pretty hard on it. So they've got the support and the numbers for it. We'll see what happens. But I think the contribution tax, the extra 30% or extra 15% on after 3 million, I think that will go through without too much hiccups. But the unrealized capital gains, if that gets pulled up or not, it will be really interesting viewing over the next few months. Right. So, and for all those people, like a lot of our clients contact us about this because they are concerned. I'm like, for majority of people, it's not a problem, but for some it is. So if you've got some advisors or people out there, you can check the facts. And I think a lot of people are a long way off being a problem. Have you got any final thoughts on this one, Kyle?
No, I suppose it's be aware of it now. And if it does come in, like you said, it's plan early because you don't want to leave it. There's a lot of things you can do over many years to try and manage it. You don't want to keep doing what you're doing, get to a point where you're now getting close to that. And then it limits to you what you can do because of whatever the rules or laws around at that time. So it's, definitely if you're thinking of, like I said, if it does come in and putting a property in your SMSF for commercial property and investment property, that's really something. And actually, that's another point that was raised about unrealized gains is there's a lot of people purchasing residential investment properties in super. And if that law comes in around unrealized gains, then that could potentially one area that's really hit hard. So plan early.
Yeah, plan early. And I think if it does go through, don't panic. I think there's definitely alternatives. It just becomes other options out there. And the government's always going to change things. It just is what it is. But hopefully common sense comes to the forefront, but that doesn't generally happen. Like the financial planning industry over the last probably 3 or 4 years has been in a changing period, and we still haven't got some simple things through. It's ludicrous in my opinion. But anyway, if you're watching this, hopefully you got something out of it. If you need some help with it or need some questions answered, please feel free to reach out and book in a call. But if not, we'll see you on the next episode. And thanks for watching.
Thanks, Dave.